top line's growing very fast. It's growing fast in the US. It's got a nice business model which will start delivering more recurring income when it's embedded in its customer systems. But yeah, I think it looks in much cleaner shape now. It raised a little bit of extra money a few months ago because this claim was sucking the cash out. So it's got a sort of nice cash buffer now, hopefully, to move into profits and keep the growth going.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello Chris, good to see you again.
Hi Lee, good to be here. I'm thankfully in the sunshine of Portugal at the moment.
Yes, how is sunny Portugal?
Yeah, good, very nice. Perfect climates at the moment. So yeah, I'm with the family here.
Perfect.
What's the weather like?
It's actually sunny today, but it's forecast to rain. But we'll see, it might not.
Okay,
But it's actually sunny. I'm actually in shorts and t-shirt here myself.
Good, excellent. Pleased to hear it. You can't see me, but I am.
No, I trust you are. So in today's episode, we're going to cover house prices. What's the impact of the general election on the stock market, Chris? That's going to be an interesting question for you to answer. UK small cap and AIM as usual. We've got a bonkers bargain, a couple of takeover approaches, and then Bloomsbury Publishing. Before we get into the general news, I thought we'd start off with some really good news for PCI-PAL. They've just had a court ruling go in their favour, haven't they?
Yeah, they have. Yeah, it's one of our stonking small caps, a fast-growing company that suddenly was being laid low with a spurious patent claim from one of its rivals. And this has consumed so much money. It's an absolute waste of time, in my opinion. But poor old PCI-PAL has put up with it. It's stood its ground. Many may not have, but it stood its ground. And it's had a ruling in its favour in the UK courts. And it's had an interim award of cost to PCI-PAL of 1.1 million. So great news, PCI-PAL. Hopefully this is a good sign. It's still to be heard in the US courts. But this is great news. And the shares rose 15% on the news, and they've really ticked up higher on the sort of suggestions, or the rumor that things are looking better in this spurious claim. But yeah, I just think it's terrible for a small company to be subjected to things like this.
How long has Investors Champion covered PCI-PAL, Chris? How long has it been on the radar?
About 2.5 years, maybe longer, 3 years. It shot up a bit to begin with, like everything. It tailed off when everybody's disinterested in technology, but it's starting just to move into profits. It's still good. Top line's growing very fast. It's growing fast in the US. It's got a nice business model which will start delivering more recurring income when it's embedded in its customer systems. But yeah, I think it looks in much cleaner shape now. It raised a little bit of extra money a few months ago because this claim was sucking the cash out. So it's got a sort of nice cash buffer now, hopefully, to move into profits and keep the growth going.
Yeah, some good news for once, for a change for the UK small caps. And, as always, if you want to learn more about the stonking small caps, bonkers bargains, then visit Investors Champion. And it's extensive write-ups and reports on these companies, isn't there, Chris?
Yeah, there is. We've got a lot on PCI-PAL. As I say, we've covered all the news for the last 3 years and the rationale for why we've considered it a stonking small cap.
Brilliant. So shall we move on to the UK house prices? Because the UK house prices certainly has a big impact on the UK economy, doesn't it? And record high for May, which is, again, a bit of good news.
It is, yeah, according to data from Rightmove, which covers everything. It's good news, as you say. It's so intertwined, and we bang on about it all the time here, how important the property sector is to the UK. And this is, I think, a positive sign. Number of sales being agreed in the first 4 months of the year is at 17% higher than last year. So good, yeah, good news.
Yeah, agreed. We've also had the announcement of the general election, which is going to be in July. How does that have an impact on the stock market, or does it not really matter? Is that not really much of a concern for you, Chris?
From my perspective, I think it's always a short-term sentiment thing. I think often the press reads more into it than is really the case. What is really driving stock market, international markets? What's really driving international markets? Typically the US stock market, and what's driving the US stock market at the moment is a business that we're going to cover, Nvidia. I think it's simple, really. So we're all back to one stock. But yeah, I don't think the UK election has a huge, meaningful, longer-term impact on stock market. And when we talk about the UK stock market, it's largely the FTSE 100. The FTSE 100 comprises of large international companies. Their UK exposure is typically the smaller part of their business for the majority of them. So why would a UK general election have a huge impact? It's just far less relevant that I think than people make out.
Yeah. Do you think, whether it be Labour or Conservatives, do you think the policies that Labour may roll out would have an impact? Would they be different to Conservative policies and in
I
terms
think
of economic growth and things like that?
Labour have proved themselves so far over the last few months or year of being quite business friendly. They're
Right.
doing their best to sort of woo business leaders because it's in their interest as well in terms of getting elected. And I think they're actually been doing quite a good job. If anything, I can see them supporting growth and business, which maybe hasn't been the case always in the past from their party.
So perhaps maybe not too much of a deviation from.
Who knows? But that doesn't appear to be the case at the moment. And quite
Yeah.
frankly, they need growth. They need to support growth. That's got to be a key part of their manifesto, hasn't it? And they want to support growth. They got to really get behind business and companies.
Yeah, agreed. Bit of international news, Chris. Nvidia. What a company this is. Wow.
You can't look. A lot of UK investors may be starting to wake up to this. You cannot ignore this business. This business is dominating stock market returns. It's now the third largest listed company in the world, $2.3 trillion market capitalization. You know, a $2.3 trillion company in old money would not have been growing very fast. This thing has just announced revenue soaring 262% year on year in a quarter. 262% revenue growth. Just a reminder, Nvidia is the company that's designing the chips that are going into support artificial intelligence. So company is a huge beneficiary of the AI growth. So next time you go on to Bing Create or ChatGPT or Gemini, Google's Gemini, and start using it, your actions are more than likely being processed by this company's chips. It's all encompassing this business. And as I say, I dread to think what would have happened to the stock market if it had disappointed. But it's not only hitting consensus, it's exceeding them. Revenue for 3 months, $26 billion against consensus estimates, which were already huge, of 24.7. It's just massively exceeding at every level. Its profitability is immense. It's got, I think, its operating margin, its net income margin, the net profit is a staggering 57%. You don't see many companies like this.
How would you play this, Chris? Because, just looking at a chart here and that share price looks fairly vertical by many measures. How would you play this? Because, I mean, it might not be wise just to jump in right now, but if you wanted to add it to your portfolio, which I know you already have it in your
Yeah,
portfolio.
it's a difficult one. We've still got it. We've obviously taken off a few profits along the way. This is an associated business fundamental and an investor's champion. It really is a difficult one at this stage. What do? Do you look at what the rivals are doing? Rivals are trying to come out with competing chips, the likes of Amazon, Apple. They're trying to develop their own AI-focused chips, but this lot, Nvidia, just miles ahead, and it outsources the manufacture to others. This is the beauty of it. It's quite a low capex business. It lets the likes of Taiwan Semiconductor Manufacturing produce the things. That's why these margins are so huge. The big question is, how much further can this go? People say that AI is still in its infancy, so we've got decades of this. If that's the case, Nvidia is surely the place to be. And I would say that if you have any belief in it at all, you have to have a exposure to this company.
Yeah. And of course, we're not saying to run out and purchase any stocks at all. This is just a conversation. Please do your own research and your own due diligence.
Yeah, absolutely. Absolutely. And as you say, it is a difficult position now. You look at a stock that's gone this fast, this quickly, and this big. Can it keep going? That's the key question.
I guess as well, looking back in the past, companies like your Apple, your Facebook, your Amazons, there was probably times throughout the past 10 plus years, decade or so, that investors probably looked at those companies and thought, I've missed the boat. It's already gone.
Yeah, they did. Yeah, absolutely. And we've all done it. And you think, oh, crikey.
Yeah.
We did it first with Nvidia. When we invested, it was on the growth of the chips that were doing well in the video gaming space. Subsequently, post-pandemic, the shares absolutely sunk.
Right.
And bing, off they go again on the back of AI. So an initial big sharp down turned into a very big winner.
So you started buying it based off the computer chips, which at that time, it was looking quite well priced. And then the AI came along and
yeah, it's peaked and it's troughed, and it's now moving to a huge peak and a much longer term one than was originally the case with video gaming chips.
Brilliant. That was a really good breakdown of Nvidia, and definitely something that people perhaps maybe would have to be patient for an opportunity maybe.
Yeah.
But should we move closer to home, look at some UK focused companies?
Yeah, I thought it was interesting because retail sales have apparently sunk by more than expected. UK retail sales have been really disappointing, but at the same time, two elderly consumer-facing names seem to be doing quite well. And one of the most well-known consumer-facing names of them all, really, in Marks and Spencer. Their shares hit a 5-year high, forecast beating results. Poor old Marks and Spencer, they're absolutely flying. It's reinstated a dividend. The turnaround plan seems to be working. Not just the food business has all been pretty good, but the clothing and the home bit that was struggling. But yeah, good old Marks and Spencer's. Out of the ashes, we seem to have this renewed youth coming out from this elderly footsie player. Sales were up. Group sales were up just shy of 10% to 13.1 billion. Great stuff.
The group has achieved 180 million in cost savings this year and has identified a further 100 million in potential cuts, surpassing its previous 5-year guidance. That's an incredible amount of savings, isn't it?
I know. Yeah, but you do wonder,
What was going on?
I know, what have they been spending it on? I know they've been refocusing the stores and things and dumping ones that clearly they don't believe have a future. How could a business like this still be finding this number of this value of savings? It's just crazy.
Yeah, and in the last quarter, M&S has emerged as Britain's fastest growing grocer alongside Lidl and the retail arm of Ocado, which it holds 50% stake in.
Yeah, this is Ocado's retail bit, not Ocado's business-to-business bit. They've got a joint venture. And yeah, it's good. The problem is that it's actually probably drawn attention to a problem there. Unfortunately, the Ocado bit isn't making money. Ocado retail losses widened there. So I hope that's going to move into positive as well. That's still a bit of a drag.
Yeah, it's still pretty impressive, isn't it, that in the last quarter, Britain's fastest growing grocer alongside Lidl.
Yeah. And for all the wonderful hype with the likes of Nvidia and the US tech giants, you've seen there investors that were canny enough have had a fantastic return out of Marks and Spencer over the last 2 years. Brilliant.
There's a really good point, actually, isn't it? Because Nvidia and the likes and Facebook and Google, or Alphabet, should we say, Amazon and Apple, they get all the limelight, don't they? They get a lot of coverage. But here we are, little Marks and Spencer's, a UK, very old brand. It's doing quite nicely.
And it didn't take an investment expertise, probably, as we've said before, to really uncover the potential here. The shopper would have seen before anybody else whether things were improving in Marks and Spencer.
Yeah.
And if they were buyers of shares, they would have thought, I might buy a few of those. I think they're getting better.
Yeah. What about Mitchells and Butlers? Now, I'm sure many will probably not recognize that name, or perhaps maybe many will. I shouldn't really surmise that, but I was quite surprised at the list of brands they actually own. I was quite impressed by some of the names.
Yeah, I know. It's a big pub restaurant group. Ember Inns, All Bar One, Harvesters, Miller and Carter, the well-known Toby Carver everywhere, Vintage Inn. So it's got 17 brands. So even if you didn't realize it, you'd probably have eaten at a Mitchells and Butler over the last few years.
Yeah.
But yeah, it's been a decent pandemic recovery story. Sales are on the up, a mixture of subsiding inflationary pressures and progress in cost savings like energy costs have helped operating margins. And it seems to be still a good recovery play. But for us, the problem with this business is that it's debt. It's carrying just over $1 billion of net debt. And that excludes lease liabilities of another just shy under $500 million. So I think it's got to keep bringing that down. It's another business with what many view as very tired brands. A lot of those brands I've mentioned don't really excite people. Many people think have they had their day, but they're still delivering that decent numbers.
The market cap is 1.7 billion versus tangible assets of 2.2 billion. Do you think the assets are really worth that, 2.2 billion?
That's the key, isn't it? Are those assets, I mean, they're supposed to revalue them, but are they worth what the balance sheet says they are worth? It's a tough one. And there's such huge coverage across the country, but you've got some decent tangible asset backing in there, which you should have on a pub group, a restaurant group. From our perspective, in terms of asset backing, we like actually one of their rivals, well, a much smaller rival, but Young & Co. the Brewers, which it doesn't brew anymore, and is simply a pub and restaurant hotel group focused on London and the southeast. It's got only 230 establishments, but it's still family controlled. And unlike Mitchells and Butler, it's much smaller debt. The debt is much more manageable. So gearing's only about 25% on this business compared to 30% for Mitchells and Butler. In net debt's a modest 185 million quid. Again, though, much Mitchells and Butler, you've got tangible net assets of 731 million, far in excess of what its market capitalization is at 556 million. So you've got lots of asset backing. Yeah, so the one thing I would say about if people are interested in Young & Co., watch out which share you buy. because you've got two lots of shares. You've got non-voting shares with the ticker YNGN and voting shares with the ticker YNGA. And most people seem to like voting shares. The prices of the two are quite different. And as a result, if you buy the non-voting shares, the price is only around 650 pence a share. And the dividend yield based on that is 3.3%. If you buy the voting shares, the dividend yield's only around 2%. So unless you have an urge to vote, and there are no other differences other than this ability to vote at meetings, which quite frankly, if you're a tiny minority shareholder, is relatively meaningless. But unless you have this urge to hold the voting shares, it's much better to buy the non-voting shares in Young & Co.
How much are the voting shares as well?
£6.50 non-voting, £10 voting.
Why would a company do this, Chris? Why would they have two shares?
Voting shares are typically in the hands of the founders stroke, with a greater number of voting rights typically in the control of the founders or the family in case of Young & Co. It must have been a quirk in history that they then issued non-votings to raise new capital, but still allow the family to control things. And you're left with this odd scenario. I've never seen it like this, the differential to this extent, though.
Would each of those respective share prices rise the same, or would those share prices rise in tandem together?
Difficult thing to answer definitively. It hasn't been the case. Clearly, the votings have been rising more than the non-votings, but
is that why there's a disparity then between the prices?
Yeah, but should the gap narrow now, I would say you got a better reward potential buying the non-voting, but it's an interesting one, and you're paid to wait a little bit more in the form of the dividend yield. So conceivably, look, everybody talking here, they start going out and wanting to buy the non-voting. Everybody listening to this here, sorry, would drive up the shares, which would narrow the gap to the voting, which would therefore start depressing the dividend of the non-voting back down again. Because of supply and demand start kicking in.
Yeah, interesting. Is there much research on Investors Champion for this company?
Yeah, we've covered Young & Co. a lot over the years. It's a very old business. I should disclose as well that we hold Young & Co. in our AIM, we as in the fundamental AIM portfolios as well, our associated business. Look, it hasn't been the most thrilling of companies, but we think now it looks reasonable value. It's a very nice business. It's very well run.
Brilliant. Should we move on to a company that we have covered in the past as well, and that's Naked Wines?
Yeah, I thought it would be worth drawing attention to this. This has got something going on in it that I think people should be aware of. Naked Wines is an online wine retailer. It's clearly been struggling. It used to also own Majestic, which is now owned by private equity, Majestic Wine, which has been doing really well. Naked Wines appears to be controlling the losses a bit better while revenue fell. It's adjusted EBIT, which earnings before interest and tax, that's what EBIT is. It's not really profit per se, but it was a little bit better than expected. But its real loss is going to be a bit much bigger because there are lots of impairments and provisions. But yeah, look, we still question an online-only wine retailer like this, but selling pretty standard products. It's got a tough space. It's competing against the big grocers, the supermarkets, where you can just pick up a bottle and you're tempted by offers all the time. And at the upper end, it's competing against the specialists. And in the meantime, its sister business, Majestic, is going from strength to strength with face-to-face tastings and everything. But the real quirk about this business, Naked Wines, is the fact that when you join a sort of club, you're so-called angel investor, and you join as an angel, a wine angel, you pay your money in up front regularly, and you start accumulating a pot of credits, as it were, that goes towards future purchases. The problem is that this money you're paying to Naked Wines is commingled seemingly with all their other cash. It's not ring-fenced. In theory, you could get it back. So if you start paying in your regular amounts and it gets to 100 quid, 200 quid, and you suddenly say, well, I'm not really tempted by any of these wines, I want my money back. In theory, you can demand it back and credit back to your bank or your credit card. And it can't, I don't think it can do anything about it. Everybody starts doing that broadly at the same time. Naked's going to find itself out of cash. I'm just surprised it isn't obliged to ring fence this cash from its own cash, which its AIM rival, AIM peer, Virgin Wines, tickers Vino, Virgin Wines does. Virgin Wines always discloses its cash and its customer advances cash separate as two separate amounts, whereas Naked doesn't.
From the numbers, then we don't know how much cash is this angel money, shall we say, compared to actual profits. We don't know how much they've got sat there. The customers are paid in terms of these angel payments.
Well, it looks like it's around about 80 million.
Oh, that's quite a substantial amount as well, isn't
So
it?
if you deduct that, it's saying that its net cash, it's saying its net cash was 20. If you deduct the 80 from that, you're in suddenly a net debt of 60 compared with a net cash of 20.
And I guess the risk, as you've already mentioned, if a large number of those customers suddenly decide, I want my money back, then that could be an issue, couldn't it?
I think it is. I just think it's a bit dishonest again. I think it's a bit dishonest. But worst thing, we remain unconvinced that the business model an online wine retailer, online only like this, of standard product can work effectively. The cost of acquiring a customer is so high relative to the potential retention of that customer. As I say, that customer doesn't have to keep buying from them. It can be, it's tempted all the time from other sources. Notably, the
Supermarkets, that's what I was thinking. Supermarkets are a big challenger to this type of business model, aren't they?
yeah, worth looking at. It's again, focus on it. Much like that little quirk of the Young and Co shares. If you want to buy shares, look at the company and see what you're buying into, because not all may be as it seems.
Yeah, shall we move on then? One of Investors Champions bonkers bargains. XP Power's received an offer, haven't they?
I will just briefly mention this is this was a really cheeky, opportunistic offer. XP-PAL has really been suffering. It's a developer of, manufacturer of power control components. Used to be an absolutely brilliant business, and it probably overexpanded. Debt was too high, and everything started falling to pieces a bit a year or so ago. A lot of profit warnings, and it raised some new capital. It's got supportive shareholders, and it seems to be improving now. But in the meantime, a US listed business has come in and made a cheeky offer. They've said this is the third offer. All these offers all started when XP started announcing trouble. The offer price, well, it's a massive premium to the current share price, but it's well down on where this business used to trade. It's a fraction of where it used to trade at, which it could easily get back to if it sorts itself out. But yeah, XP Power didn't want to engage with this. This is the issue with this business. The US potential acquirer has come in and put out an announcement itself saying, look, we have made all these offers, but the management isn't engaging with us. So XP Power has been obliged now to say, look, we haven't engaged because we're not interested. So yeah, highly opportunistic and classic case of where the market stands for many UK small caps. Just everybody's swooping on them.
When you say the company needs to sort itself out, what type of things would you like to see them do to get back on the right track and try and regain some of that share value that they once had?
They seem to be doing it. They seem to have righted the ship, which is good. They're obliged to hold back on any more acquisitions. They haven't got the firepower to do that. They've got new funding in place. They've got supportive debt lines in place, seemingly. A lot of it's just a matter of timing and waiting for the return of some of their markets to return. They support the semiconductor market. They support the pharmaceutical healthcare market. So they've got various in industrial sectors. Some of these markets haven't been doing that well, but they will come back.
Right.
So you've just got to, and look, this is exactly what the buyer sees.
Yeah.
It's simple. It sees a once great business that used to deliver fabulous margins trying on its lows. Wow, let's have a go.
I believe Bonkers Bargain has got a bit of limelight as well, hasn't it? It's being used on another well-known investment brand.
Yeah, I think I was a bit miffed by this. Our Bonkers Bargains terms, we think other people were using, they haven't used the actual term exactly as we do, but Bonkers Bargain referring to a crazily cheap stock, but they've tried to use it in some form. So I suppose it's flattery.
Yeah, flattery. Who was it? Was it Investors Chronicle?
Oh, I wouldn't like to say.
No,
might have been there.
No, I'm not sure it was them, by the way. So I couldn't possibly say. And carrying on the theme of bonkers bargains, go on. How do you pronounce this one?
Ixico. This is a tiny business. It's barely worth focusing on, but we just think it looks ridiculously cheap because it has got some decent intellectual property. It's trying to support the delivering insights into neuroscience to up our understanding of it. Clearly, there's more positive news and drug development in the combat against Alzheimer's. But Ixico analyzes lots of scanning data. Again, it's a quasi AI play. It's only worth 3.5 million quid, this business at the moment. It's got cash. Just announced a decent contract relating with the Global Alzheimer's Platform Foundation, contract worth £1 million over 48 months. It's suffered from contract delays. They seem to be coming back. So yeah, keep an eye on it. It's trying to do interesting things. Another business doing interesting things, but valued at absolutely barely anything.
UK prices. Valued at UK prices.
Yeah, valued at UK prices. It's got to be worth more than 3.5 million, and it's got the cash in the bank seemingly to support it and see things out, hopefully to cash flow break even.
Do you think that's why Keyword Studios has also received a takeover approach? Do you think that's why others see value in this company?
This is a massive AIM company. It's a provider of solutions to the video games and entertainment industries. We hold it. We Fundamental Asset Management hold it on our AIM portfolios. Again, it's a business that was absolutely flying during the pandemic when the video gaming sector was flush and everybody thought we'd all be doing for the rest of our lives was playing video games. But again, it's received a private equity funded offer, 70% premium to the share price.
Wow.
On the day before, everybody's thinking, whoa, whoopee-doo.
Yeah.
Look, this is still not back to where it was 12 months ago. And the keywords, the difference with keywords, this is a £2 billion. This offer is at $2 billion. It's one of AIM's biggest companies. It's the largest player in its market. It's the largest service provider to the video gaming sector. It surprised all the big games developers, Activision, Blizzard, Electronic Arts, Microsoft, Netflix, Tencent, all of them. It's got a roster of all the big names. It's 3 times the size of its next largest competitor. This is a really important AIM company and a really important company in the sector.
So you hold them in the fundamental portfolio. Would you want to accept this offer, or would you want them to carry on as an AIM-listed company?
I'd love them to carry on as an AIM listed. I hate offers. All I see offers at the current, particularly at the current moment. It would be different if we were in a different era. But at the moment, everything still looks decent. And a lot of these businesses are just recovering from lows, from tough times. I'd like to see them see it through. It would be certainly a lot more fun seeing it through because I think they could have gone to much greater things. But the difficulty with this one, a 70% premium on quite a big company, is probably going to be tempting to some people. But it has a willing shareholder base that seemingly up to now have been happy to support its growth. So why bail out now if you really think there's potential? Private equity see their potential. What more can private equity do that the stock market can't do to support this? If the right management team's in there to do it, it would be sad to see it go.
It seems like every week we're talking about a takeover or a takeover approach or two, doesn't it?
Every day. Maybe a topic for another podcast, probably, that takeovers.
Yeah, that's a good idea, that actually, isn't it? Because it'd be interesting to get your thoughts on them, and been a lot, hasn't there?
Yeah, absolutely.
It would seem to me that this type of company is the exact company that Jeremy Hunt only mentioned last week that we were discussing, that these are the types of companies Jeremy Hunt wants to see grow and become potentially the next Apple, the next $1 trillion market cap company. This is the type of company he would want to encourage to stay and grow.
It looks like it. You're right. It ticks all the boxes. UK-driven company with international exposure, international growth, dealing with all the big blue chips around the world. Fantastic.
Yeah, you would think that is exactly the company that Jeremy Hunt wants to keep and promote. But hey, who am I to say? Should we wrap up then on a well-known and popular company with the private investor community, and that's Bloomsbury?
Yeah, I thought it'd be worth leaving with this one. It's a publishing house, and it's done very well over the last few years. It's well known for publishing the Harry Potter series, which is still a big revenue contributor for Bloomsbury, but it's recently been doing very well out of Sarah J. Maas, the fantasy writer, and her novels have helped revenue jump 30% in the year to 342 million, and her profits leapt 57% to 49 million. And shareholders are getting an extra dividend as well. It does very well intermittently out of some big releases that can really start to deliver, whether it's J.K. Rowling, Harry Potter, or Sarah J. Maas and her fantasy novels. But in the next year, pre-tax profits are forecast to decline 27%, and this reflects the fact that there are no new Sarah J. Maas titles scheduled for the period. Who knows, they might come on to another blockbuster author. But that is the nature of its business. And investors that have been prepared and willing to accept some of this sort of blockbuster volatility have done really well. It doesn't just do consumer-facing titles. It's got a digital non-consumer business as well, educational business to iron things out. But these seem to be still small contributors. In the academic side as well, we've had the likes of publishers like Pearson, are big players in this space, and there's artificial intelligence now that it's impacting things. But look, Bloomsbury, if you've been prepared, if you're prepared for a little bit of volatility and this occasional sort of big successes and years with not big successes, but the cash flow from the big hit helps feed other areas of their business to iron out the returns a little bit, less boom and bust stuff. As then you wait for hopefully the next big one again.
Is there a way to kind of anticipate whether an upcoming book is going to be a big hit, like Sarah J. Maas sort of style?
Very easily. With Bloomsbury, you can see who they publish. It's all visible. If you could have seen in the market that sales of Sarah J. Maas were really resonating with people, particularly I think US as well, it would have been clearly evident. You can get in there again. There's public information out there, give you some reasoning to buy the shares.
Should we leave it there then, Chris?
Yeah, another good session.
Yeah, I think so. We covered plenty there. Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.